Welcome to Business Talk Podcast. I'm your host Deepak from India. We are honored to welcome Dr. Sanjay Kallapur and Dr. Hariom Manchiraju, esteemed faculty members from the Indian School of Business, Hyderabad, as our distinguished guests on today's podcast episode. Before we begin the conversation, let me take a moment to introduce our guest for today's episode. Professor Sanjay Kallapur is a leading accounting expert at ISB Hyderabad with prior services at Purdue University. Renowned for research in financial and managerial accounting, corporate governance, and risk management, he has published in top journals and contributed to regulatory policy in India and the UK. Professor Kallapur is the founding editor-in-chief of the Indian journal Accounting Theory and Practice. He has served on the board of IDBI Bank, the Life Insurance Corporation of India, and is a member of India's National Financial Reporting Authority. He holds a PhD from Harvard Business School and professional qualification as a fellow member of the Institute of Cost Accountants of India. Our second guest for this episode is Professor Hariom Manchiraju. Professor Hariom is an associate professor of accounting at the Indian School of Business with a PhD and MBA from the State University of New York, Buffalo, a Master of Financial Management from Sri Satya Sai University, and a Bachelor's in Commerce from Osmania University. His research explores how accounting information influences capital markets, the value of financial forecasts by managers and analysts, and corporate governance, especially executive compensation. He is actively engaged in teaching financial accounting and financial statement analysis for MBA and senior undergraduate students, and is a member of the American Accounting Association. In this episode, both faculty members share insights from their research. Does observability of ratings shopping improve ratings quality, which examines whether increased transparency in credit rating processes affect the accuracy and reliability of ratings. It's my pleasure to welcome Professor Sanjay and Professor Hariom to the conversation. Professors, we are truly honored that you have accepted our invitation and delighted to have you with us today.
Thank you, Deepak, for inviting us. It's a pleasure here.
Likewise, Deepak.
Professors, what motivated you to investigate the impact of mandated disclosure of unaccepted ratings on ratings shopping practices among Indian issuers?
Okay. Credit rating agencies are an important financial intermediary in the credit markets. And this whole arrangement is subject to conflicts of interest because the credit ratings that they give determine the interest rates. They determine the bank capital adequacy requirements, and so on. But these users of the ratings do not pay for the ratings. It is the issuer who benefits from a lower interest rate, who actually seeks out the rating agency and pays them. And the rating agency's contract is with the issuer. So it has the elements of conflict of interest that while the investors want the accurate picture, the person who pays for the ratings, the issuer, wants to their ratings to be overstated. And this credit rating agency is a for-profit entity. So this is an interesting setting by itself. And regulators have been worried about this conflict of interest. They are aware of this thing called ratings shopping. And the Indian regulator, SEBI, did something unprecedented, which is that they made a regulation that requires credit rating agencies to disclose if an issuer has come to them and sought a rating. That's so because this is an unprecedented regulation that other jurisdictions have only talked about. It is seemingly makes sense because of the conflict of interest involved. And therefore, all regulators in USA, Europe, they have talked about this kind of rule, but they have not actually gone ahead and made that rule. So in India, SEBI made that rule. which is what motivated us to investigate this issue.
Yeah, Professor Hariom, your take, please.
No, I very much concur with Professor Sanjay. I would just want to add that this phenomena, which we term as rating shopping and catering, these are worldwide problems. It's not something unique to India. So just imagine that as a issuer, I want to get the highest possible rating. So I go to one rating agency and ask, for whatever reason, they don't give me the rating that I wish. So as a issuer, I have an option to hide that rating, file it in my desk, and go to someone else and ask for a better rating. Now, because these agencies also are revenue driven, they have incentives to not let go of the business, and someone will eventually fulfill the requirements of the issuer by giving them the higher rating. So the tendency of the companies to go and ask around for better ratings is the shopping, and there is a pressure on the agencies also to comply with that. That's called catering, and these problems are there in entire world. So, as Professor Sanjay said, SEBI has taken a step which is not seen anywhere in the world. Having said that, for the last 40, 50 years, theory recognizes that better disclosures or enhanced disclosures is the way to fix that. I mean, the famous unraveling principle based on this. So this brave step by SEBI kind of motivated us that let's see what theory predicts. Does that really pan out with the data? Was our trigger point for this study.
Dr. Sanjay, could you explain the concept of rating shopping and how it traditionally contributes to rating inflation by credit rating agencies?
Sure. So as I was saying, the issuer has the right to decide which rating agency to go to. And as Professor Hariom was saying, they can go to a rating agency, get the rating, and if they don't like, then they can say, okay, I'm not going to publicize this. So think of a student who takes GMAT 5 times. And if they don't have to tell about all their attempts, then they will only tell people about their highest score, which by definition is higher than all the other scores. And so that is why if they are allowed to tell people only their highest score, then that contributes to a ratings inflation because whichever rating agency gives them the highest rating for whatever reason, they will only publicize that, and it is bound to be higher than all the other ratings that they got. Because they didn't tell you about all those other ratings in the first place. So that's how ratings inflation happens. But then the second part, as again Professor Hariom mentioned, is that this creates a pressure on the rating agencies themselves because they want the business. So they want to cater to the issuer's interest in getting a higher rating than they really deserve. So both of these phenomena contribute to the ratings inflation, which of course all regulators are justifiably worried about, because then it affects the market. People will end up paying, getting a lower yield for their bonds at a higher risk. So investors can get hurt by this phenomenon, which is why the regulators are justifiably worried about this.
Professor Hariom, what makes India's regulatory experiment with mandated disclosure distinct in the global landscape of credit rating agency oversight?
So before I answer that, I want to just compare and contrast what happens in India and the credit rating industry versus the rest of the world. And broadly, the takeaway is everyone is working in the more or less similar environment. This conflict of interest that comes from the issuer-paid model, that's pervasive across all jurisdictions. The pressures like rating shopping and catering are also very much prevalent. Having said that, there are factors like reputation and regulation that will prevent the race to the bottom. The market is still intact because at the end of the day, these factors in terms of reputation and the threat of regulation are keeping the quality under check. So these factors are present everywhere in the world. Right. Another key feature is it's a highly regulated industry with very few players. In the US, there are just big three. In India, we have at least seven, even though the market is captured by top three or four. So the market dynamics are also very similar. The difference which arose is in terms of how to tackle this problem. And in the US and many developed economies, regulators have left it to the wisdom of the investors. And for example, if an investor sees that a company has put forth only one rating, they will assume that the company might have gone to the other rating agency, would have gotten a bad rating, and therefore they will hide the rating. So that assumption is implicitly made by the investors. And the research has shown that if there are bonds, one is rated by just one rating agency, another is rated by multiple rating agencies. The other one, which is rated by multiple agencies, it gets a favorable borrowing rate. So the decision making is in a way left at the wisdom of the investors. Which is the hallmark of free economy in many ways. Having said that, there are certain problems with that assumption also. That in reality, the company might have gone just to one agency. So there is no way for investor to disentangle whether just one rating agent, one agency or one rating which is out there, it's a artifact of shopping or the truth itself that the company was so confident about its prospect, it just went to one. It thought that the other would also give the same rating, so therefore it didn't even try to get the second rating. Right? In India, what has happened is this assumption is done away with by the regulatory action. So effectively, the SEBI is forcing the rating agencies that if someone approached you, you gave them rating, they didn't like it, they didn't buy it, you still need to disclose it on your website. So the assumption that investors need to make, that is done away with, and the reality is brought to light. That's the key difference.
Professors, in the context of your findings, how did the new regulation affect the behavior of issuers and their choice of credit rating agencies?
So one would think that once the company has to disclose the rating, then the phenomenon of explicit ratings shopping would stop. That is, there is no point in going to a rating agency and then I, as an issuer, not publicizing that rating because the rating agency is putting it on their website anyway. However, we found, to our surprise, that still a lot of ratings are being rejected by the issuers. So at least it looks like they genuinely believe that they feel that the rating was wrong in their context. The other thing is that a lot of the issuers the rating agencies, there are 7, as Professor Hariom mentioned. Then they vary in quality. Some are stringent, others are more lenient. So the market share of the more lenient rating agencies, we found that increased after the regulation came into effect, which is, we call that as implicit shopping. That is, you don't actually go and get a rating, but you know that, okay, this rating agency is going to give a stricter rating. So better not even go to them in the first place. Go to the other one, which we know, I mean, through experience and through the experience of others. The issuer will know that those rating agencies are likely to give a more lenient rating. So they go to those rating agencies more and more. That's what we have observed. So we call this explicit shopping and implicit shopping.
Professor Hariom.
Yeah, just to add on to what Professor Sanjay mentioned, see, a lot of it is there are certain investment grade ratings. So unless you get that rating, the chances of a issuer getting a bank loan or raising the bonds become less. And what we find is because of these regulatory benchmarks or requirements, if the issuer has not gotten a investment grade rating, that is when they are more likely to shop around. So not the strongest of the companies, but those who are on the borderline, which will put them in a better possibility of raising debt. Those are the ones that shop more.
Professor Sanjay, what are the main differences you observed between type 1 and type 2 errors in credit ratings after the disclosure requirement was introduced?
Okay. So, firstly, when a rating agency gives a rating, they are not saying that this company will default or will not default. That is probabilistic. Okay. But for the purpose of evaluating their ratings, otherwise they would say, okay, we gave a 20% probability of default to them. They didn't default. Yes, we said that there was 80% chance that they would not default. And there would be this kind of escape clause for every single company. So the way probabilistic ratings or probabilistic predictions are evaluated is by looking at their statistical properties over a number of events. So if the weatherman says that there is a 40% chance of rain, and we actually, that single forecast, we can't evaluate whether it is correct or not. But they do these forecasts day in and day out. So of all the times when they said there is a 40% rating, I'm sorry, when there is a 40% chance of rain, did it actually rain 40% of the time? This is the kind of statistical test that is used to evaluate the quality of a forecast. So in the context of ratings, as Professor Hariom mentioned, there are some investment grade ratings and there are non-investment grade ratings, which are also popularly called junk bonds. The bonds that don't get investment grade ratings are called junk bonds in the popular terminology. Okay, so a rating of BBB and above is investment grade. So one test that we do is if the rating agency gives an investment grade rating, which means the rating agency is saying that the probability of default of this bond is very low. Does it actually default? Okay, so that is the type 1 error. They said it won't default. To simplify what they are saying a little bit, they said it won't default, but actually did default. Okay. So if the ratings become more accurate after this regulation, then we should observe that the type 1 error, which is the times when they say it is not going to default and it still defaults, that percentage, that probability is going to decrease. But to our surprise, we found that it increased 2.65 times, and this is a very large proportional increase. Um, so that is about the type 1 error. The type 2 error is that the rating agency says that it is going to default, which means they give a junk rating. They give a non-investment grade rating, something below triple B. But the company bond does not default. Okay. So the rating agency is being conservative. Okay. So SEBI would expect, we would expect that as a result of this change, the type 2 error will increase because the rating agency will become more conservative. But we find that the type 2 error decreases by 37%. So again, a very large decrease in the type 2 error. So this is what these type 1 and type 2 errors, along with the percentage of downgrades, these are our main tests to determine whether the quality of the ratings improves after the regulation, which is what SEBI wanted. And we find that it actually decreases.
Dr. Hariom, your analysis suggests that enhanced disclosure lead to more future downgrades. Could you unpack the possible reasons behind these unintended consequences?
So the rationale is exactly the same like what Professor Sanjay explained us. But the future downgrades are a little bit more broader occurrence when compared to defaults. Defaults are going to be somewhat rarer events compared to downgrades. Downgrades effectively are capturing a deterioration in the financial and the economic well-being of a company. Right. Now, let's think in terms of the context of rating shopping. It's likely to be highest when a company is going for a fresh issuance. That is when the issuer is going to put maximum pressure. And suppose the CRA buckles, that is when it is going to give a much more inflated rating. Subsequently, time passes, and that is the time when the course correction happens. The rating agencies can now go back and say that, hey, since the time you issued bonds or raised debt, 1 year has gone by. We have fresh set of financial statements, so we are going to review our ratings. And at that time, invariably, if they want to backtrack on the optimistic rating that they had given earlier, they're going to downgrade the rating of that particular issuer if the economic reality is also moving in that direction. So for a large lot of research has documented it that shopping in the year T is followed by a downgrade in the year T plus 1. So that completes the circle. Now, if this better regulation or disclosure requirement is likely to put this tendency under check, what we would expect is the tendency of future downgrades should go down, right? But we find the opposite result, uh, which is very much in line with the type 1, type 2 errors. It's just that we are broadening the scope of our study, that companies getting a favorable rating when they issue, and then the very next year they are notched down. That frequency or that tendency increases almost threefolds after this regulation. So again, a unintended consequence is not what SEBI would have wanted, but that's what is actually happening.
Professor Sanjay, how does the emerging phenomenon of implicit shopping, where insurers selectively seek out lenient CRS, pose new challenges for market transparency?
So if the ratings are getting inflated without the company's actual fundamentals warranting that particular rating, then it is a misleading rating. So One of the biggest impacts is that affects the calculation of capital adequacy for banks. So therefore, the entire system of prudential regulation of banks, whereby they have to hold capital in proportion to the risks of their assets, the risks of their loans. Mm, that capital adequacy calculation is skewed by the fact that these ratings are now improperly inflated. So that the entire system of prudential regulation of financial institutions of banks, that is one casualty of this kind of process. And second, we find that investors give less importance to the ratings because investors can see that this is what is happening. They don't just blindly take whatever rating is given and price the bond accordingly. Uh, so this has the negative effect on the truly. So if everybody gets a high rating, then who suffers is the person who truly deserves a high rating. So it is like when there is ratings inflation for students, when there is grade inflation for students, who suffers is the good student because then the market does not value that A grade for them. Mm. That's another effect on market transparency, which is a negative effect of this phenomenon.
Professor Hariom, did the new rule have any measurable effect on ratings inflation as perceived by the market participants and regulators, or did it merely change the way inflation occurred?
Yeah, so that's what our findings are suggesting, that rather than explicitly going around and shopping um, and then hiding the unfavorable ratings, the way rating inflation is happening is changing. The companies are now directly going to more lenient agencies and then trying to get the best possible rating. Now, this would happen because companies already have certain expectations about the likely standards which these agencies are likely to follow, or based on their past experience or the experience of their peers with the lenient agencies. Certain expectations would be formed, and then rather than going to the stricter one, risking a bad rating, the companies will directly go to more lenient agencies. Having said that, there are a couple of caveats I want to put in here. The technique that we follow is called difference in difference, wherein we are seeing the regulation came in 2016. So we are comparing what happened 3 years before and 3 years after. The shorter window helps us pinpoint the effects. Because if we elongate the window, a lot of other concurrent events can happen. So we cannot attribute any changes confidently to this particular regulation. So we need to keep in mind that our analysis is based on 3 years of time after the regulation has happened. Maybe 3 years is not sufficient. Maybe for statistical purposes, that's a great choice, but maybe things will take longer to pan out. So that's something we need to keep in mind. The other thing is that I believe eventually the reputation of these lenient agencies will catch up. That if they forever keep on inflating, then people will stop trusting them, and that's what Professor Sanjay was alluding previously, that eventually not just the companies which are using their rating, the rating agencies also would their reputation would be questioned, and then whatever they put out, that would not be taken with confidence. So for the reputation effects to catch up, we need longer time. 3 years may be short. um, Another caveat I want to put in here, that this enhanced disclosure requirement was a part of much broader regulation which came up in 2016, which had several other features A very important one. See, earlier, two different rating agencies would have two different scales. Someone will say double A plus, someone will say capital A, small A plus. So, different agencies coming up with a non-standardized scale. So that scale has been standardized. The agencies are now required to give a very clear explanation about the rationale. Um, there are a lot more internal checks and balances which the agencies have to follow. So, in the longer run, so even for the investors, the agencies now need to give a history of what ratings they have provided to the same company for similar instruments. So, collectively, all these mechanisms, it will take time to show the positive results. So I would say that, I mean, our results are showing unintended consequence, but that needs to be taken with perspective that it's a very sharp, short-term duration that we are examining, and then other aspects of the regulation as well as reputation would take some more time to show effect.
Professors, what recommendations would you give to policymakers seeking to combat rating shopping without encouraging other form of strategic behavior from issuers?
So this is a difficult issue, and we see these with multiple different market intermediaries. It is a similar issue with auditing, with rating agencies, and so on, which are all across the world dealt with by different regulators. So, considering that we have not found an ideal solution, we have to say that this is a difficult problem in the first place. And when the problems are difficult, the chances of unintended consequences are quite high. So I would say to the rating agency, I would say to the regulators, uh, do keep in mind the possibility of unintended consequences. And academicians and academic research tends to be good at pointing out unintended consequences. So give more importance to academicians and academic research in making these policies. Mm, uh, and of course, as Professor Hariom mentioned, SEBI has also done a lot of good regulations, which have increased the transparency in the market. One of the other regulations that was part of the same package was that the rating agencies have to disclose the averages of how many companies they gave which rating and how many of them did default. Okay, so that sort of transparency enables everyone to understand the quality of the ratings given by the different rating agencies. So that transparency is clearly a good thing. So in general, more information is good. Actual interventions to prevent the way the market works have to be tailored very carefully. And we have to be humble enough to recognize that we can't even predict all the consequences that might follow. There are unintended consequences that may not be obvious at the outset.
Yeah. Professor Rio.
I concur with Sanjay. I mean, many times it's like a cat and mouse race where regulator is a step behind. Um, and I do agree that maybe the direct intervention may not solve the problem because people will find another way to fix that. But in general, the greater transparency is the way forward. The more information everyone has, uh, collectively better decision making could happen.
Professors, I would like to conclude this episode with one last question. Based on your research, what further steps can marketers or regulators take to ensure that credit ratings genuinely reflect underlying credit risk, especially in emerging economies like India?
So as Indian stock financial markets have become quite mature, so I wouldn't call India to be an emerging market in the sense of needing different regulations than the other parts of the world. Maybe you have to tailor it to the settings a little bit. But again, the rating agencies present in India are again the subsidiaries of the rating agencies in the other parts of the world as well. So the situation is quite similar here versus other countries. And so these lessons are applicable worldwide. Mm. And as I mentioned, that information is good, more transparency is good, uh, but actual physical interventions in the way the market works is not, it can have unintended consequences.
Yes. Professor Hariom, your last take.
Yeah, I will take a little bit more leeway. In the previous question also, I was a little bit guarded, but since you're pointing it again, I'll take a little bit more leeway here. In addition to transparency, I think competition is also one very important factor that generally improves the consumer experience in several areas. And I think rating agencies or this rating industry being highly regulated with very few players is something that can be looked at by the regulators. Now, what I'm saying is not easy in terms of structural changes. And it's just an experiment, easy to say, but very difficult to implement. So I understand its limitations. But I would like to point out that a new semi-industry which is coming up in India is the rating for the ESG performance. And right now, there are about 19 rating agencies registered with SEBI, which are a mix of issuer paid as well as the subscriber paid. And in my mind, credit rating market is much bigger and easier to quantify than the ESG ratings as such. So when we can have a lot more players of different variety in one market, why can't we have it in the other market? Um, would it eventually change or not? I don't know, but that will be a good question for us to answer if SEBI eventually opens up.
So, Hariom, there is some research that looks at the effect of competition in these kinds of markets. And I have done some research on the audit markets. And the finding generally is that in these kinds of markets, more competition is actually bad. It decreases quality. And worldwide, private credit is becoming a phenomenon that regulators are getting worried about. Private credit has its own set of rating agencies. There are more of them there. And there is a lot of concern being expressed after the first brands defaulted. People didn't even know how much they owed, and there is a lot of opacity in that market. And those rating agencies that operate in that market are also. So more may not always be better.
But that would be a good question for us to answer.
That's an excellent question.
Thank you. Listeners, thank you for joining us for this insightful episode with Dr. Sanjay Kallapur and Dr. Hariom Manchiraju from ISB Hyderabad. We hope you enjoyed learning about their research on ratings, shopping, and the impact of regulatory transparency. Stay tuned for future episodes, and thank you for listening. Thank you, Professor Sanjay and Professor Hariom, for sharing valuable insights from your research with our audience. Your contributions are truly appreciated and will be remembered. Thank you so much.
Thank you.
Thank you, Deepak, for this great podcast and this great series of podcasts. It is you are popularizing research and bringing it to a wider audience. That is a great work that you are doing. It was an absolute pleasure to be on this podcast.
Thank you, Professor.